Good afternoon, everyone. I hope you're all keeping safe and healthy during these times. Today on the call, I am joined by Mr. Rajiv Mehta, our CEO, Mr. Shashidhar SK, CFO, and Mr. Devan Dhruva from Orient Capital, our investor relations partner. We have uploaded our investors deck and result highlights on the stock exchanges and the company's website. I hope everybody had an opportunity to go through the same. Post the relaxation of the lockdown restrictions from early June 2021, the company has been doing well and has delivered a strong performance in the second quarter of the year. Revenues in the quarter have grown by 53%. Our company delivered a strong performance on back of stellar volume growth and better product mix. We have grown through all channels: general trade, modern retail, and of course the dominating e-commerce. For the quarter, our pressure cooker category had a volume growth of 53%, and this contributes to 26% of our revenues. Our non-stick cookware category had a volume growth of 14%, and this contributes to 17% of our revenues. Our cooktop business, the gas and induction cooktop category, had a volume growth of 31 and 53% respectively. That is, the gas cooktop business grew by 31% and the induction cooktop grew by 53%, which contributes to 13 and 8% of our revenues respectively. Collectively, they contribute 21%. Our new segment, the LED, had a volume growth of 70%, and this contributes to 7% of our revenues. Small appliances, that is mixer grinder and others, had a volume growth of 34%, and this contributes to 30% of our revenues. The company is focused on our own manufacturing. Our trading sales have also reduced considerably during the last few quarters. There have been now these products we are manufacturing, and so they contribute from the manufacturing sales. During the last quarter, the price of raw materials have increased substantially, which has led to reduction in gross margins and therefore EBITDA margins too. We have missed out to pass on these increased input costs completely to our customers. We have taken some measures and also increases in the price of our products across all categories, and we expect some more price increases in the coming quarters. The company is continuously investing in improving the facilities and investing in backward integration and building better infrastructure to create a differentiated value-added product for our consumers. We are backward integrated to now make all the parts of our pressure cookers, that includes gaskets, the rubber gaskets, and the weight ball. We already are making handles. The production of our rubber gaskets have already commenced and is catering to 100% of our requirements. We have also installed a state-of-the-art manufacturing facility for the weight ball, which will very soon commence production. Along with this, we have a glass lid line installed capacity of 32,000 pieces per day, which will cater to the requirement of our non-stick cookware. All these days, we are importing these glass lids. We also have the ability to manufacture components such as backlight handle, sheet metal components, molded parts, die-cast parts, molds, dies, and fixtures in-house for the manufacture of our products. We believe the backward integration of our manufacturing facilities has reduced our dependence on third-party suppliers and OEMs. Such components reduce costs, which have resulted in mitigating the unprecedented price increase. During the quarter, our costs on branding and marketing increased due to lockdown in Q1 of this year. Some of these costs spilled over to this quarter. We believe that continuing to develop awareness of our brands through focused and consistent branding and marketing initiatives is important for our ability to increase our sales volumes and our revenues, grow our existing market share, and expand into new markets and new product categories. The digital platform and social media has enabled us to reach and engage with a wider audience and customize product offerings. The company plans to spend between 3 to 4% of our revenues in branding and marketing on an annual basis. In the coming quarters, the company is planning to launch a range of plastic storage containers. We call this the modular storage range. Also, we have now a full range of LED bulbs that is starting from 0.5 watt to 50 watts, which is now made within the company's manufacturing facilities. Our focus is on increasing distribution, increasing network across the country. Customers are onboarded to increase our number of outlets. Over the first half of this year, the company has added over 11,400 new retail outlets. That is an addition of 20% of the existing outlets as of March 2021. During the quarter, the company introduced and completed 100% successfully a distribution management system. The tool helps improve operation and provides effective sales and inventory management related only to pigeon products. This provides information on the right stocking pattern and enhances efficiency due to the faster transaction. It also helps the organization to track secondary and tertiary sales and maintain inventory level at the distributor center. It gives us visibility to the secondary billing happening from the distributor to the retailers. Despite the increased raw material costs and increased branding and marketing, we have maintained our EBITDA margins at 11.9%. We have been constantly given guidance of achieving EBITDA margins between 13 to 14% on an annual basis, and we look forward to achieving the same. In the current quarter, profit after tax is lower by 9.2 crores as the company had to provide for income tax, and after setting the accumulated losses brought forward from the previous year. Coming to financials, our ROCE stood at 33.6%, our ROE stood at 21.6%, gross debt stood at 53.4 crores, and our working capital days stand at 23 days. With all this, we will now open the floor for questions and answers. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kondunya Nimagada from JM Financial. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Great revenue growth numbers. So just trying to understand, what is you did again mention that the EBITDA margin is going to be 13 to 14% odd range. So do you think there is any risk to these numbers as far as FY22 is concerned, or would you like to revise that guidance lower for FY22 for gross margins and EBITDA margins?
We believe that the cost increase in input cost has actually plateaued now, and we are also, based on the current cost, passing on the cost increase. There has been a slippage in the second quarter particularly, and we have taken steps for correcting this. Post it, I think normalized, we will be back to normal business, and the differential of the 2%, 2.5% that is there will be covered, and maybe a little more so that we get back to between the 13 and 14%. We are confident of getting there.
Got it. So, sir, what is the price hike that you took in first half of FY22? Also, if you can help us understand when you took those price hikes.
So, at the beginning of the year, the majority of the categories we have taken a price increase of 5%, and we thought that could be good enough. But there was a sustained increase of input costs, which I think again we have recalibrated our costs, and we at the beginning of the third quarter have taken a price correction again across the various categories that we deal with. I think with this new price correction, we will be back to our normal margins.
Understood, sir. And sir, can you also help us understand, what is the tax rate going to be like from here onwards? Because we thought, we had carry forward losses, and then mostly it will be in the second half of the year also when the tax rate would increase. So just trying to understand what would be the tax rate for the coming quarters and also for 23 and 22 and 23.
So the current year will continue to have the benefit of carry forward losses of 40 crores. But prudent accounting practice, we have provided in the ratio for the whole year. It's not that we have observed all that in the first or second quarter. So we have, based on our AOP, the ratio of that, we have only observed that much of it and provided for the taxes. And also the company wanted to be prudent enough to pay advance taxes so that it does not at the end of the year we end up paying only for those 2 quarters. So the company has also paid these taxes, and we continue to have that benefit for this year. Whatever the number we end up with, 40 crores of this will be non-tax. Only profit beyond the 40 crores will be taxed at the normal rate of 25%.
So just to clarify, this year the average rate of tax will be 14%, and in terms of absorbing the brought forward losses. So next year onwards, the normal corporate tax of around 45.17% depending on the profits which you record.
Understood, sir. Understood. Sir, just again coming back to the business, just trying to understand if there is any channel stocking that has happened for the upcoming festive season in 2Q. And so just trying to understand, from that perspective, how is the 3Q numbers could be like? I mean, as in, what is the current demand scenario is like?
Fortunately for us, both, as I already mentioned in the call, that we have implemented a DMS. This helps us to track the inventory both at the distributor and the retailer. And there has been a very good, tertiary sales. And so there is no channel. In fact, from the day one itself, from October 1st, we have had the same kind of sale numbers that we had experienced in the previous month. And the demand continues. So to say that there is any stock lying in the channel or choking the channel, I think I can only say that there is a very healthy stock at the secondary.
So if I understood it correctly, that channel inventory is at normalized levels.
Yeah, normal inventory levels, yes.
Sir, and just one more question, if I may, sir. You entered into plastic storage containers, like, so just trying to understand, what is the market opportunity here like, and what is the growth that you're foreseeing here? If you can help us speak a little bit about that.
We are to launch this storage containers. Of course, initially it is plastics, but they will be of different material. So gradually we want to build a range for the storage. We believe this is an important item that is used in the kitchen, and so we are launching one range, that is we call this modular range in the plastics. But going forward, we will have other metals and other materials also, but the category will be storage. We believe this is the same channel which actually also where we have an opportunity to sell this, whether it is the general trade, modern retail and e-commerce. And we have got very good feedback from the initial research. We have yet to launch the product.
So what is the estimated market size and all, like, and how it's just current structure? I guess it will be mostly unorganized, right?
Yeah, so honestly, there is no proper data to give you that kind of numbers. But we believe that a lot of this unorganized business is shifting to organized, and also with the channel, with the network that we operate, there is a huge opportunity. It's only about placing these products and ensuring the right quality and at the right price. There is enough opportunity there.
Sure, sir. Just two more questions from my data keeping questions. So what is the A&P spend in the current quarter, and also the e-commerce mix of total revenues, if you can provide that?
Your current quarter, you are talking about the third quarter or the second quarter?
Second quarter, sir.
May I, sir?
We are well within the 3% of that revenue.
3%, sir. Okay.
Yes. Within the 3%.
And on e-commerce mix, sir, what is the current contribution from e-commerce channel?
So far, for the first half of the total revenue, we 250 crores of the 577, yeah. 251 crores was from e-commerce.
And exports, sir?
Next quarter.
Exports.
Exports, we are at about 70 crores. That is the OEM. So we have a combination of OEM and brand exports. So the combine of this is at 70 crores.
So just trying to understand, if I look at the non-stick cookware numbers, I get a feeling that exports we haven't done much in the current quarter vis-a-vis the first quarter. So just trying to understand what is the current order book like and what is the outlook on the exports front.
So there has been a steep price input cost escalation in the non-stick cookware, particularly non-stick. Majority of the input costs comprises of aluminium. And so we have been a little more stringent with our customers to correct the prices. So the work is in progress. So we are still growing over the last year, but we have curtailed some of the orders to protect our margin.
Understood. So I'll come back for more questions. Thanks for this.
Thank you. The next question is from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
This is Andre here, Sangeeta's partner. First of all, congratulations for a great set of numbers. I hope to continue going forward. I really want to understand a little bit more about your distribution strategy and how you mentioned in your presentation that you have a completely separate distribution structure for each of your three brands. Now, I just wanted to understand if you could break up your value sales by Fujin and Gilma and Black & Decker, and also tell us as to which of your distribution retail outlets belong to each of these brands. Also, if you had ever at any point of time considered some commonalities in terms of having a common structure for maybe let's say Fujin and Gilma, and if you have decided against that, what is the reasoning rationale behind the distribution strategies?
So let me clarify to you. First of all, they are at different levels, catering to different segments of the consumer. And even the networks are different. So Gilma, we sell it only through our exclusive outlets, which are currently only in the southern states. Fujin is a national brand, and we sell it through multiple channels that includes the general trade, e-commerce, modern retail, the institutional sales. So Gilma is exclusively sold only through our own exclusive outlets for Gilma. Black & Decker, of course, has a different channel because this is placed at points where it is catering to a different segment of the consumer, which is the premium end. And so, and today the Black & Decker range is more stronger in the north, and we are still yet to build the network strongly in the south. We are there, but it is a totally different outlets. Most of the outlets are not common; they are different outlets. So both the distributor and the channel, overall the dealers are mostly different for these two, and we wish to keep this segregated separate. Because they are catering to different segment of the business.
And what is the value split between these three brands?
Yeah, today it is very small. Between these two brands, it contributes to 6% of our revenue. Otherwise, it's all the Fujin brand.
So how, of the 6%, how much is Gilma and how much is Black & Decker?
More or less, they are equal.
More or less equal. Okay. And there is no potential for creating any commonalities in distribution, even at the distributor level.
No. So again, I want to repeat: these are different strategies of reaching the consumer in a different way. The product mix is also a little different, and wherever if products become of mass consumption, then we bring it under the Fujin brand, and then the moment it is under the Fujin brand, then we are getting to all the channels. It is available through across, which is catering to a larger segment of the population. The Gilma is strategically placed to cater to a different segment, and the products also are such that they require very special display and understanding of the product because initially they are new, and so we believe that the Gilma strategy is totally different. It does not. The idea is not to have overlapping brands just for the sake of it. They are to target different business segments. So I think these are two different approaches to the totally different approach. So I don't think even in the near future you'll see these two merging together.
Okay. Thank you. Thank you very much.
Thank you. The next question is from the line of Prithvi from Unifi Capital. Please go ahead.
So on the volume side, has there been any spillover from Q1 that we have seen in this quarter? And then, as you said, the inventory levels have become normalized now. So what kind of volume growth are we looking for coming quarters and next year?
Of course, we have in our presentation given you details of our volume growth of the various products, and we believe that the growth remains. It's a continuous thing. So while the third quarter of the last year, we believe was relatively normal and good, but still over that we believe that at the rate that we are growing, we will continue to grow the same levels. If you want me to repeat, I can say on the pressure cooker front, in the first half, we have grown by 81%. I can tell you it is far above the industry and far above any other peer group. The gas cooktop business we have grown by 35%. Induction cooktop we have grown by 82%. Non-stick cookware we have grown by 33%. Our LED is also grown at about 67-70%. In the small appliances category, as a whole we are growing. It is a whopping 70%, but some of the categories we become leaders like kettle and choppers. We are leaders in this industry now, which I can tell you a relatively new category, large category in the large contribution. So overall, I can tell you these are all very high growth numbers. But the third quarter is a real comparable one because it was normal times over the last year also. I think, but over the last year's numbers also, we are seeing good demand. So we believe that will grow again.
So, if I have to quantify this number, say, going forward, given it's a normal base, can we expect 20 to 25% volume growth?
I think that's quite achievable.
Right. And secondly, on the gross margin front, as you mentioned, you have taken price hike. So can we expect gross margins to go back to 35% level from next quarter onward?
Yeah, we believe that we will get back to between the 33 and 35%.
And could you quantify the price hike that you have taken in this month?
Yeah, around 5%. Last month, that is the beginning of this quarter, we have corrected our prices across categories around the 5%.
And just a bookkeeping question. So what is the current export order book for you?
So I said that we are having a very strong DMS system for the general trade, and both export and modern retail, we have a longer visibility of the orders. I can at the moment say that it is very robust. The demand side is also strong and the order book is also good.
But is it possible for you to share the number, the order book number for export?
I don't think I have it ready, or I don't think I can share it more.
Okay. So one final question on the income tax rate. So over and above 40 crore accumulated loss, you will start paying tax, right?
No, in terms of percentage, I think to clarify, if we will go annualized basis, we'll be end up paying 14% as taxes. And for the coming future, it will be at normal 25%. Once we net off the 40 crores of carry forward this year, then all will be normal. Currently, we have not observed all the 40 crores. We only observed to the extent of the profit that we have made for this half, and remaining we have provided for the tax in the numbers that we have.
Okay. That's all from my side, sir. Thanks.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. I just wanted to understand, just now you mentioned about 20-25% volume growth and plus price hike. So 25-30% revenue growth is what one can envisage, like over maybe next 1 to 2
I think the arithmetic says so. If you grow volume growth by 25% and a small increase in cost, yeah, around that.
25-30% for next 2 years CAGR, is that one?
I think that's a very long time to comment, but we can definitely say that the next 1 or 2 quarters, definitely we are on this track, on this growth trajectory.
Fair enough. And we have spoken about earlier in terms of our normalized margin level of 15% when maybe the scale also comes up and the scenario becomes normal. Now, how far are we away from that 15% EBITDA margin level that we have been talking about?
I think the very disruptive price increase was the reason for this correction on the margin. Otherwise, the business plan and the way we have structured our business, we should be there immediately. I mean, starting from this quarter, between the 13 to 15% levels, we should expect.
Understood. All the very best. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Binoy Jariwala from Sunidhi Securities. Please go ahead.
Yes, thank you for the opportunity. Sir, I'd like to understand a bit on the distribution front. So we reach about 65,000 outlets, and what is the potential distribution universe for us which we can tap?
The broad outline looks like 2 lakh units, 2 lakh outlets, but I think we are growing at this 20% rate. We are able to add almost 20% on the base of last year.
So internally also, when you are planning on an annualized basis, you look to add roughly about 20% to the distribution reach every year?
Yeah, we believe that we can, this 20% has happened over the last 6 months. So it's not annualized, and if not to multiply that, but we believe that we can grow at about 30% year on year on the number of outlets.
Understood. Okay. So second question is on the cost plus model which we follow for the Pigeon brand. Just to understand a bit here, when we say cost plus margin, do we base it on a certain level of gross margin or a certain level of EBITDA margin?
No, the business is working on gross margin, and of course, because generally our costs are also then based on that. So while we price our products based on the gross margin, eventually it's close to the EBITDA. So more or less, I can tell you, we are working between 33 and 35% on the gross margin, and our costs are now well in control within the 20%. So if we hit at 35%, we'll definitely get a 15% EBITDA, and if we hit at 33%, we'll definitely get a 13% EBITDA. The kind of thing. On the cost side, we are in total control within the 20%.
No, I understand, sir. Just wanted to understand from the angle, let's say, if you are working on a cost plus gross margin model, then you are essentially looking to hold gross margin in a particular range, and thereafter, any operational efficiencies that you extract flows on to the EBITDA margin, right? So essentially, what I'm coming to is that your EBITDA margin may or may not
to answer
14-15%.
There is a possibility of improvement, but I think for the current quarters, the upcoming quarters, the target is to ensure that we get to our gross margin and retain our EBITDA margin at the aspire. But as we grow, obviously in terms of percentage, the cost may come down by 0.51%, and obviously that will flow to EBITDA. We would want to retain our gross margin at the aspired between 33 to 35. In a normal time, we would want it to be at 35. There could be sometimes slippages like what has happened in the last quarter. So we want to keep that range between that 33 and 35.
You wouldn't look to pass on the extra benefits or cost benefits, cost savings to the consumer in terms of lower prices or something like that, right? That's what I just.
So we are already very competitive for the combination of the quality and the network and the service that we provide to the consumer. We are at the lowest range for the kind of brand that we are. The consumer does not expect us to be cheaper than this. We have a good demand at this level itself. As it is, because our costs are, overall cost of the product itself is far better to the peer group. And with this lower gross margin that we have over the peer group, As it is, we are very attractive. We don't have to go below this. I can say this is a sweet spot for us. We would not want to maximize our gross margin, remain there, and garner as much as market share as possible, rather than increase cost. But I don't think we need to go below this.
Understood. That's very helpful, sir. Sir, and in the earlier calls, you've given a guidance of growing about 25% revenue this year. Now, in the first half itself, you've grown by a handsome 75 odd percent. So, would you like to increase your guidance or something like that?
I believe that's a healthy guideline to grow at 25%, and it also should be digested by the investing world, that includes you. And if you grow better than this, I think nobody's offended or feel let down. But of course, the current opportunities are a little different, because last year was a little more challenging than the current year. I don't say there are no challenges in this first quarter. There were, but compared to the last year, it is much better. But if it is normal times, I can say that we can grow better, because the nature of our business, we are investing more and more on our backward integration. Our costs are coming down. We are able to control quality better than anybody else. Our supply chain, in the current times of the destructive nature of the current times, in spite of that, we have no challenges in the supply chain. All these will lead to a growth rate which will be larger than the industry. And so, if it's normal times, it can grow better. But I think for the current, I can say whatever we achieve growth in the first half, we will still grow at the rate that we have promised you in the second half. So maybe there will be annualized, it will be a little higher growth than normally what was the guideline.
So 25% growth is on a normalized basis for slightly longer term. Is that what you are saying?
Yeah, we believe it can be for a longer term, because we are continuously adding more products. We are increasing our distribution reach. We are increasing our geographical presence. When I say that, we are there everywhere, but there are several geographies where we can strengthen our presence. So with this, and as and when we add some more channels, when there is a need to, I think all this combination of all this can allow the company to grow at about 25% for a longer term.
Thanks, sir. That's very helpful and very detailed. Sir, only two bookkeeping questions. Now, on the capex front, we had guided for 65 crores of capex in FY22. We've already done roughly about 60 odd crores in the first half. So, is there any revision to this capex? And second question is on the suppliers credit that we have roughly about 15 crores. Is this interest bearing or non-interest bearing?
So, suppliers credit is not interest bearing on our books. So, this is either, say, we would have given some LCs to our suppliers, and they will, whatever is at all they are going for financing of these receivables, it is to their cost. It is not to our books. And another question?
On the capex.
Yeah. So this year, the normal capex that we planned was between 50 to 60 crores on the manufacturing activity, and then we are seeing a little more free cash flows, and we wanted to enhance the returns on this. So we have additionally invested in the solar energy, or the hybrid, I can say, renewable energy, which work is in progress. The majority of that is already done. Some more is happening, and almost close to 30 crores is being invested on this. So while a majority of this is already done, there could be another 10 to 15 crores of capex in the current year itself. That includes this 30 crores of investment in solar power. The company's energy consumption to an extent of 70 to 75% will be met by internal generation of power from the coming, I can say, from the fourth quarter.
Understood. So essentially you are saying about 50, 60...
But may I please request you to rejoin the question queue?
I'm just clarifying this point, nothing else. essentially, sir, you're saying about 50-60 crores for the manufacturing plus 30 crores for the solar plant. That's right?
Yes, you're right.
Okay. Thank you so much, sir.
Thank you. Before we take the next question, a reminder to the participants, please limit your question to 2 per participants. You may rejoin the question queue if you have a follow-up. The next question is from the line of Mayank Bhandari from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. Sir, I had first on the distribution side, you said that there is a almost 10,000 touch points increased. So can you give a rough breakdown that in which geographies it has increased?
Just a minute, Rajiv will answer you.
Yeah, hi Mayank. So the increase has happened in both Pigeon LED and Pigeon. The total increase has been 11,400. Of that, about 7,000 has been in Pigeon, and the remaining 4,400 has been in Pigeon LED. In Pigeon, about of the 7,000, 40% has been in the region West. West includes, for us, it includes Rajasthan, Maharashtra, Gujarat, Madhya Pradesh, Chhattisgarh. These are the areas which are in the West. In South, it has been 15% because the base is already high, and the rest is in North and East. And when it comes to Pigeon LED has increased largely in the South. We have got about 50% increase in the South, followed by followed by West, which is Rajasthan and Gujarat. These are the 2 new areas which we have opened. And last, West Bengal and Uttar Pradesh. So that is the split of the 7,000 for Pigeon and 4,400 for LED.
Okay, that's great, sir. Second question is on the export side. So we have seen a lot of players commenting on the increase in the freight cost, particularly pertaining to the export. So are we also experiencing the similar headwinds there? And what would have been our freight cost in this quarter? Maybe you can give some idea. Also, with the distribution expansion in northern and western parts now, is our freight cost slated to increase for the full year? If you can provide anything on that.
So freight cost for export, Mr. Gandhi will answer.
So for us, all our export prices are FOB. Of course, there has been some crazy freight for the export business, but it does not affect us because all our costs are only free on board, and it does not affect us. But the input cost itself for these products that we import, there has been a very steep price increase. We are also we are able to get this price increase from our customers, but there has been a disruption during this period because generally the nature of any buyer, when there is such a steep price increase, he would always want to negotiate. So there has been that, but otherwise we have passed on all the price increase as far as the cost of input is there, and freight does not affect us. It is only free on board.
And Mayank, for the rest of the country, while we have increased distribution, we have been working very hard to ensure that freight cost is under control. And today, freight plus the C&F commission put together is 3%, which was much higher. And we have worked on bringing it down by almost a percentage. So for most distributors who can take direct, we bill directly to them and not through C&F. And through C&F, we only do part truckload. So we are constantly working on making sure that freight cost does not go up.
Okay, thanks. My last question is, sir, on how is the festive demand panning out now, particularly in the last one month? If you can throw some light on that.
The festive demand has been good. It has been the same as what it was in September. We have not seen any softening of the demand. Pigeon being a great product at a great price, I think we have had a good run so far, touch wood, and we continue to see that demand in October and November.
Okay. And lastly, sir, one particular question that there is varying commentary from other competition that people are now shifting back towards the offline channels, but your number does not seems to be showing that. So any comment on that? What is the kind of trend you are seeing? Are people continue to shopping on e-commerce platform, particularly in the last 1 month also?
No, so for us, offline, which includes modern retail and general trade, both have shown good growth. Of course, e-commerce has been growing, but both general trade and modern retail has shown growth better than expected. And we can say that after the lockdown in the month of May and beginning June, we have seen good, robust growth coming back in both these. So yes, people are going offline, and we are seeing that demand coming back.
Thanks a lot.
Thank you. A reminder to the participants again, please limit your question to 2 per participant. You may rejoin the queue for your follow-up. The next question is from the line of Achal Lohande from JM Financial. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations for the great sales performance. Now, my first question is, with respect to the sales, is it possible to get some color in terms of the contribution from the new categories? In let's say last year FY21 or in the first of FY22, what would be the revenue mix from these categories which we have expanded in the last 3 years?
Well, in the investor presentation, we have exactly the number, the contribution of each of these categories and the growth. We have both these numbers.
Well, I think you're talking about the revenue mix. And I'm implying for the new categories, something like LED or the smaller categories which we obviously wouldn't know in the presentation. So I'm more curious to know that mix, sir.
So LED, we are at 6.6% in contribution, and the growth is almost 70%. So these two combinations will give you exact number. I can say in the appliances, of course, a combination of all this, and where the kettle is not separately shown in the presentation. But otherwise, yeah, electric kettle, we have already a contribution for the current year at 41.3 crores only from the kettle, which is actually in terms of growth, what the growth is? 50%. Is the highest growth after the mixer grinder. We are at 147% growth on that over the last year, same period. And the mixer grinder is contributing 32 crores, and this growth is 168% over the corresponding period last year. Of course, chopper continues to grow for us. The contribution is 26 crores for the period that is reported, but it has grown at 65.24%. So that is all the appliances. But otherwise, we have separately given you pressure cooker, separately non-stick, separately tops.
Okay. And you think that kettle was...
These numbers separately. There's no problem.
Sure, sir, sure. The second question I had was with respect to the the cost inflation. Is it possible to quantify what is the cost inflation for some of the key raw materials like aluminium, steel, copper? What is the impact for us? And when you say that we've taken another 5 to 7%, will we be covered fully, or you think there is one more round which is required to cover fully for the cost inflation what we already have seen till now?
So I can tell you at the overall level, there is an impact of 2.4% is all due to the raw material cost. And so we have at a overall category, overall level, wherever it was needed, we have taken a price increase of 5%, but at a contributing level, it will nullify that 2.4%. It will be a little better than that, so we will be back to the normal margin.
Okay, sir, just to clarify, if we see the competition in the appliances has taken a price increase between 10 to 20%, in last few months. Does this mean that, the price gap between us and them has probably widened?
Increasing, you are right. And while I would not be able to comment on competition, but the gap at the consumer will further increase we believe that we will want to protect our position again. So we, of course, have slipped on the gross margin for the last quarter, but we are working on that and will be definitely back at the gross margin level that we are. With this 5% increase, it is covering all the impact that has happened because of the raw material cost. And otherwise, in the other spheres of our cost, we are actually increasing our efficiencies, whether it is employee cost or it is the freight forwarding or even the business promotion and advertising expense. I can say we are becoming more efficient. So if we retain this gross margin at the level that we wish to, that is between 33 and 35, definitely we are more efficient than peer group, and the difference for the consumer at the point of consumer will further increase. We'll only stand to gain market share with that.
Answer, sir. What is the absolute A&P spend?
Sorry to interrupt, but I would please.
A&P, we are currently at below 3%. Or if you want
somewhere around 10
to
crores?
it's 15 crores.
We spent 15 crore in the second.
Lohandi, I'm so sorry.
In the period, that is first half, is not the quarter.
Thank you so much. Thank you, sir.
Thank you. The next question is from the line of Himanshu Nair from Yes Securities. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on a great performance, sir. So firstly, I understand that we are growing much faster than the industry, but just wanted to understand in your view what the entire industry, especially in traditional categories like cookware and cookers, is growing at such a fast rate. In your view, what are the structural reasons and whether this sort of growth rate is here to stay now for the industry as such, sir?
So I can say the consumption is definitely growing, but whoever is going to be more efficient and consumer base that we are catering to is much larger than we believe the listed peer group. So obviously, because of this base, the consumption in this base growing higher than other PG. So we believe that we will grow at a higher rate than the industry. Of course, consumption is growing. It's also that in the past, what used to be capital goods kind of thing is becoming consumer goods. These category of products that we are in also has a replacement cycle, which is also accelerating. I can say the life cycle of these products is reduced from what it used to be. All this is leading to higher consumption. The industry is growing, and with the consumer category that we are catering to and the efficiencies that we are building within the organization, we believe that with these two combination of these, we will grow at a higher rate than the industry. For a near term, I can say for a long future, it will continue to be there. As long as the country remains conscious on cost, we will be very relevant to the consumer.
Understood, sir. Understood. And sir, second question, now that we are widening and diversifying our range of products quite significantly, are we looking to aggressively invest in, say, setting up our own chain of retail stores, something like which our competition has done? And also, if we are looking at more investments in strengthening our service network to further build our brand equity for pigeon specially.
At the moment, it is at deliberation stage at our board, and it's not that we have chosen on any concrete plan, but definitely it is at discussion stage on building our own retail. On consumer, post-sale satisfaction for the consumer, it is a continuous effort. We are increasing the number of franchisees, we are increasing the number of our service personnel, and also for us, consumer delight is taking precedence over everything, and this will continue to be there. I can say that there is a lot of scope for improving on this, on the consumer satisfaction index. If there is a scope, and we will definitely address this. So I can say that both these are fluid at the moment, particularly on the retail you asked, but it's at the deliberation stage, and we will definitely announce you once it is actually it is run through the board and it is approved, and they will definitely bring it to the investors.
On the service front, we are using digital tools. Very soon you will see a revamped website of Stovekraft, which will have a chatbot linked to WhatsApp. We are also working with a large aggregator of an app which will be able to give an instant confirmation for a service call. Of course, like Mr. Gandhi said, the number of service franchisees will increase. And on top of that, as we add digitization, then it will help in increasing consumer delight.
Understood. That's great to hear, sir. Thanks, sir. That's all from me, and wish you and the entire team a very happy Diwali.
Thank you.
Thank you.
Thank you. We take the next question from the line of Vishwit Nayak from RW Advisors. Please go ahead.
Yes, sir. Could I get your commentary on inventory and receivable levels as of now? They seem a little bit higher as H1 FY22.
Yeah, more. See, we are also installing new lines and new plants. This has definitely increased because of the also increased volume. This has increased inventory levels. But I think actually as we go forward, this number of days we are working on this to reduce further the number of days of inventory. So if the revenue number definitely grows up, the absolute number will also look northwards. But in the terms of number of days, we are continuously working to bring it down. Today, from what used to be a 37 days of working capital on March 20, it had moved to 27 days on March 21, and the current half we are already at 23 days. So in absolute working capital days, we are at a far improved number of days. We believe that in the times to come, we want to bring it to zero.
Understood. And the new categories on kitchen storage container, what kind of capital outlay are we looking at it, and would it be a traded good, or are we looking to set up a...
Invested in plastic injection molding machines. We have a very large setup, very high quality setup, and these are additional molds. We have a design house in China, and molds also we make there. So we already got these molds. As and when we introduce new models, is about making new molds. The capex for the machines is already there. It is tapping to a general requirement for the overall company. I can say boastfully that in the size of business that we are and the category of business that we are the largest injection molding capacity in the country. So there is no need for additional capex for this line currently. If the business grows beyond the envisaged levels, definitely there will be additional capex. For that, we don't require any additional capex. On the mold front, I will tell you, it is not very high. Generally, one range of mold will cost you between 1 or 2 crores.
Understood. And the pricing should be in line with popular brands that we see?
Right. We didn't understand. Sorry, you said something about pricing?
Yeah, pricing of storage containers. So some of the popular ones that we see are from Nysa, Milton, and others.
Pricing is clear that we are a cost-plus model. We would want to have that reasonable margin that we aspire, so that we can take care of the company and stakeholders. Otherwise, at the price point, at the strategy that we work, we will definitely be more cost. For the consumer, it will be more advantageous to look at us than any other brand at the quality level that we deliver.
Thanks, sir. That's all from me.
Thank you. The next question is from the line of Konadinya Nemagada from JM Financial. Please go ahead.
Yeah, thanks. Most of my questions are answered. Thank you very much.
Thank you very much, ladies and gentlemen. That was the last question for today. I would now like to hand the conference back to Mr. Rajendra Gandhi for closing comments.
Thank you everyone for joining us. I hope we have been able to answer all your queries. We look forward to such interactions in the future. We wish everyone a very happy Diwali and a prosperous New Year to all from the Stovekraft family. In case you require any further details, you may please contact us or Orient Capital, our investor relations partner. Thank you again.